January's housing data just dropped, and on the surface, it looks fine. National median up 0.4% to $753,000. REINZ calling it stable. Economists saying confidence is rebuilding. And if you're a property owner who's been sweating through 3 years of declines, you might finally be thinking, okay, we made it through. But here's what those headlines aren't telling you. The house price index is still down 0.7% year-on-year. We're still 16.2% below the 2021 peak. And sales? Down 5.4% from last January. So whilst the median ticked up slightly, actual transaction volume is falling, which means fewer people are willing to pay these prices, even after 3 years of corrections and interest rates at 2.25%. That alone wouldn't be concerning. January's always quiet. Summer holidays, families at the Bach, agents taking time off. But when you dig into the regional numbers, a very clear pattern emerges, and it's one that tells you exactly where this market is headed over the next 12 months. Auckland's median is down 0.6% just in December. Wellington fell 0.4%. These are the two cities that hold over 40% of New Zealand's property value. And they're not just flat. They're actively weakening whilst places like Queenstown, Christchurch, and the West Coast hit record highs. Here's the thing. This isn't a recovery. This is a market splitting in half. And depending on which side you're on, the next year is going to feel very different. So if you own property, if you're thinking about buying, or if you're trying to figure out whether to sell before winter, this is the video you need to watch right now. Because I'm going to show you the 3 forces that are actually controlling this market, why this stability everyone's celebrating is more fragile than it looks, and what you should be thinking about over the next 6 months before this window closes. This is not financial advice. Always consult a professional. But by the end of this video, you'll understand what's really happening and what your options are. Let's get into it. Right. So we've just had the January 2026 data released from REINZ. And look, the headline number is encouraging if you've been holding property through this downturn. National median at $753,000, up slightly from a year ago. That's the first bit of sustained stability we've seen since the market peaked in early 2022. But the problem is, that number hides more than it reveals. So in this video, we're going to break down 3 things. First, what's actually happening beneath the surface of this data, because the regional split is massive, and it matters whether you're in Auckland or Invercargill. Second, why this stability isn't the recovery most people think it is. Sales volumes are falling. Inventory is still elevated, and the economic fundamentals haven't shifted in the way you'd need for sustained price growth. And third, and this is the important bit, we're going to talk through the practical scenarios facing different types of buyers and sellers right now. Not predictions, not hype, just the options people are weighing up and what the data suggests about each one. So let's start with what January's numbers actually tell us. All right, here's the national picture. Median price, $753,000. That's up 0.4% from January 2025. Sales volume, 3,837 transactions, down 5.4% year-on-year. The house price index from REINZ sits at 3,582. That's down 0.7% over the past year and still 16.2% below the peak. So prices are sort of flat, but fewer people are transacting, which tells you something important. Buyers aren't rushing, and even though interest rates have dropped 325 basis points from the peak. Now, when you break this down regionally, the story gets interesting. The winners. West Coast just hit a record median of $480,000. That's up $20,000 from October. Queenstown Lakes hit a record $1.83 million. Christchurch is up 3% year-on-year to around $794,000. Southland's median is over $500,000. First time a regional area outside the main centers has hit that mark in years. These are not major population centers. These are regions with tight inventory, strong local economies, primary sector in Southland, tourism in Queenstown, and they're benefiting from the fact that they didn't overbuild during the boom. The losers. Auckland's median is $1.015 million, but that's only up 1.5% year-on-year, and it dropped 0.6% just from November to December. More importantly, the Auckland house price index is down around 20% from peak. Some suburbs, like Point England, are down 33% from their 2021 highs. Wellington is worse, down 0.4% in December. The Wellington City Index is down 27% from peak. Some western suburbs have lost over $400,000 in value. And if you exclude the headline number, Greater Wellington is down 3.3% year-on-year. So here's what's happening. The regions that boomed the hardest during COVID, Auckland, Wellington, are the ones still correcting. The regions that had more modest gains are now stable or growing. And there's a reason for that. Economists are calling this market stable. REINZ is saying confidence is rebuilding. And technically, they're right. The freefall has stopped. We're not seeing the big monthly drops we had in 2022 and early 2023. But stability doesn't mean recovery. And here's why. First, inventory is still elevated. There are 33,149 properties listed for sale nationally. That's up 2.3% from last January. New listings increased 1.3% to over 9,000 in January alone. So even though sales are falling, supply isn't, which means there's no pressure on prices to rise. In Auckland and Wellington, this is especially acute. Auckland's got thousands of unsold townhouses sitting on the market. CBRE data shows 541 new apartments built in the last 3 years still haven't sold. That's 20% of everything completed. And these aren't just empty. They're being rented out by developers who couldn't shift them. So when you hear stable prices, what that really means is sellers aren't desperate enough to drop prices further, but buyers aren't desperate enough to pay more. Second, sales volumes are falling. 3,837 transactions in January, down 5.4% from last year. And remember, last year wasn't exactly a boom year either. We're well below long-term averages. Lizzie Riley from REINZ even said it herself. Confidence is rebuilding gradually rather than accelerating quickly. Translation, people are cautious. They're not rushing in. And without volume, you don't get momentum. Third, the economic fundamentals are still weak. GDP contracted 0.9% in Q2 last year. The labor market is stabilizing according to the Reserve Bank, but that's code for unemployment is no longer rising as fast. Net migration has collapsed. It's at 2.5-year lows. Population growth is the slowest it's been since COVID. And here's the kicker. Even with the OCR at 2.25%, the lowest it's been in years, mortgage rates are only down to around 5.4% on average. That's still well above the 2 to 3% rates people were getting during COVID. So yes, borrowing is cheaper than it was 18 months ago, but it's not cheap enough to make people feel like they can stretch, especially when house price-to-income ratios are still sitting at around 6 times median income nationally. That's higher than any point before 2020. So when we talk about stability, we're really talking about a market that stopped falling but hasn't found a reason to rise. And that's a very different thing from a recovery. Right. So let's talk about who this market is working for and who it's working against. Because it's not uniform. First home buyers are absolutely winning right now. They're making up 28% to 39% of purchases, depending on the region. In Wellington, they're nearly 40% of the market. That's unheard of. Historically, first home buyers are around 15 to 20% of transactions. But right now, they've got everything going for them. Prices are down from peak. Listings are abundant, so they've got choice. Interest rates have fallen 325 basis points. KiwiSaver balances are higher than ever. People who've been saving for 5 years now have deposits they didn't have in 2021. And investors have pulled back, so there's less competition. Tony Alexander, independent economist, said it outright. This is no longer an investor-driven market. It's driven by first-time buyers. And that's been true since March 2023. But here's the catch. They're taking on more debt than ever before. Even though interest rates are lower, the absolute amount they're borrowing is higher because prices, whilst down from peak, are still elevated compared to incomes. And if you're buying now with a high debt-to-income ratio, you're vulnerable if unemployment rises or rates tick back up. Investors are sitting on the sidelines. They made up 39.5% of purchases in 2021. Now they're at 25%. And that's because the numbers don't stack up. Gross rental yields are around 4% nationally. That's before rates, insurance, maintenance, and property management. With mortgage rates at 5.4%, you're cash flow negative on most properties. Yes, Interest deductibility is back at 100% as of April last year. Yes, rents have started easing, which makes properties more attractive long-term. But right now, there's no urgency. Investors are waiting to see if prices stabilize or drop further before they jump back in. Existing homeowners in Auckland and Wellington are stuck. If you bought at the peak in 2021, you're sitting on a 20 to 30% paper loss, depending on where you are. And if you need to sell, because of a job change, relationship breakdown, whatever, you're crystallizing that loss. The data shows the number of people selling at a loss is at the highest level since 2014. And in areas like Wellington City West, some people have lost over $400,000 in value. So unless you absolutely have to move, you're holding, which is why listings in these areas are elevated but sales are slow. People are listing, testing the market, and pulling out when they don't get the price they want. Sellers in regional areas are doing fine. If you're in Christchurch, Queenstown, Southland, you're in a totally different market. Inventory is tight, demand is steady, and you're not dealing with the oversupply issues Auckland and Wellington have. So it really depends where you are and what you're trying to do. This is not financial advice, and I'm not telling you what to do. But here are the scenarios people are weighing up right now based on what's happening in the market. If you're a first home buyer, you're probably looking at whether to buy now or wait 6 months. The argument for buying now is that you've got choice, less competition, and interest rates are low. The argument for waiting is that sales volumes are still falling, inventory is still high, and there's no sign of prices rising in Auckland or Wellington. So if you're patient, you might get a better deal in winter when listings typically rise and fewer people are active. But, and this is important, if you wait and the market does turn, you'll be competing with more buyers. It's a trade-off. If you're an investor, you're probably waiting. The cash flow doesn't work yet, and prices haven't bottomed in the main centers. But you're watching for signs of volume picking up, inventory dropping, or rental growth returning. If net migration stabilizes and construction slows, which it is, then rental supply will tighten over the next 12 to 18 months. That's when yields improve. The other thing investors are watching is whether DTI restrictions get tightened. If they do, that caps how much buyers can borrow, which limits price growth. So there's a policy risk to factor in. If you're an existing owner in Auckland or Wellington who needs to sell, you're in a tough spot. If you list now, you're competing with high inventory and low buyer urgency. But if you wait, you're gambling that the market improves. Most people in this situation are trying to avoid selling unless they have to. But if you do need to move, the options are price aggressively to stand out, wait until spring when there's more activity, or rent your property out and delay the sale until the market firms up. If you're an existing owner in a strong regional market, you've got options. You can sell now and capitalize on the strength, or hold and ride the momentum if you think it continues. Either way, you're in a better position than people in the main centers. Look, no one has a crystal ball. But based on what we're seeing, here's what seems likely. Auckland and Wellington will stay flat or drift slightly lower through winter. Sales volumes will stay suppressed. Inventory will remain elevated. And there's no catalyst for prices to rise meaningfully. The best case scenario is they stabilize around these levels. Worst case, they drop another 2 to 3% as more people list and buyers stay cautious. Regional areas, Christchurch, Queenstown, Southland, will probably continue growing modestly, maybe 2 to 4% over the year. Tight inventory and steady demand support that. Rental market will start tightening by mid-year. Construction has slowed dramatically. Consents are at 2018 levels. The pipeline of new builds that flooded the market over the last 2 years is drying up. Once those properties are absorbed, you'll see rents stabilize and then start rising again. Most experts are predicting rent growth over the next 12 to 18 months. And interest rates are probably done falling. The Reserve Bank has signaled 2.25% is likely the bottom. So mortgage rates will stay around 5 to 5.5% for the foreseeable future. That's supportive for buyers, but it's not a game changer. The wild card is the labor market. If unemployment rises meaningfully, that weighs on buyer confidence and ability to borrow. If it stabilizes and wage growth picks up, that supports demand. We'll know more by mid-year. So here's the bottom line. This market isn't crashing anymore, but it's not recovering either. It's splitting. Strong regions are doing well. Weak regions are grinding sideways or drifting lower. And whether you win or lose over the next 12 months depends entirely on where you are and what you're trying to achieve. For first-home buyers, this is the best environment you've had in over a decade. For investors, it's still a waiting game. For existing owners in Auckland and Wellington, it's about patience and not panicking. The key is to understand the data, not the headlines. And that's what we do here at Kiwi Property Reports. Break down what's actually happening so you can make informed decisions. If you found this useful, hit the like button and subscribe to Kiwi Property Reports. And drop a comment if you've got questions or if there's something specific you want me to cover. Thanks for watching. I'll see you in the next report.